Welcome to the program, Michael. It's good to have you back.
Yeah, hi Simon, how are you?
Very well, thank you.
That's the way.
Today, I'm reading a lot about inflationary pressures and what's going on there, Michael. How are you seeing it?
Well, certainly the bond markets are consistent with that. So we've seen the 10-year US bond yield that fell down to about 1.15% in early August. That's back around 1.5%. So we've seen quite a sharp rise in bond yields in the last sort of 6-8 weeks. And that's consistent with inflationary pressures and central banks increasingly looking to wind back bond buying programs, and stimulus. So what's driving the inflation? Well, certainly shipping, elevated shipping costs have been in the news for some time. And that's one factor. But what's sort of adding to that now are energy costs. So I've seen oil recently, Brent got hit $80 a barrel. But certainly in some places, things like electricity, gas, coal prices, all that, we've seen quite sharp increases. So when you've got rising energy costs and a lot of backlogs with supply chains and freight shipping costs, which are not all fuel related, that's certainly flowing through to inflation. We've also seen quite, it varies from food commodity to food commodity, but a lot of the food commodities are also pretty elevated. So, things like sugar, corn, not so much, wheat, pork recently again's gone up. So you've got also food inflation. So when you put all that together, you can see why bond yields are rising. And of course, that's got consequences for other markets. I think one or two interesting stats actually I saw on shipping. There's a measure of Port of Los Angeles empty containers. And I think if we go back to, it was around about 250,000 and it fell to about 100,000 when COVID sort of struck, but it's now at about 370,000. So that's shot up, and there's an index called the Baltic Dry Index, which is sort of an index of average prices paid for the transport of dry bulk materials across about 20 routes. And that was sitting early last year at around about 500. It's now at 4,960. So you can certainly see a lot of pressures there, and that basically there's a lot of empty containers because of trade routes and supply chain issues, and also labour. With COVID, there are shortages of skilled stevedores, and as a result of that, you can see why there's a lot of pressure on shipping on top of energy and food and those sorts of things.
Definitely. And what else is driving markets at the moment?
Well, there's no shortage of things. You ask the easy questions. I guess related to what we just spoke about, China have got a bit of a power crisis at the moment, and a lot of firms are being asked to shut down for a week, or certainly curtail production, combined with them appearing to target, they're trying to engineer a bit of a slowdown. So you've got sectors like construction, property, and others, the government's trying to sort of slow down. So there are real concerns around Chinese growth as a result of both energy prices spiking, energy constraints, and this engineered slowdown. And that's one of the reasons you've seen iron ore prices effectively halve from a few months ago. So that, and there are concerns around property, overly indebted property developers like Evergrande in China, and whether there's any default risk there. So certainly China's playing an increasing, I suppose, role of nervousness at the moment. And to put it into perspective, it's estimated that China has about 90 million uninhabited properties. Now that would house Australia nearly 4 times. So when you put that into perspective, you can see why people are concerned. So that's certainly a driver. We've mentioned energy and shipping, and central banks winding back bond buying programs and inflation concerns. Look, geopolitical risks remain. They still remain quite elevated. I think what we're starting to see is a bit more risk aversion and a bit of a reassessment of valuations. So we've just seen US equities have their worst month since March last year, and that's when COVID obviously took off. And we've seen markets dropping by 5 to 6% generally on equity markets. And I think that that's sort of related to all the things we've been talking about. So how does that flow through? Well, the Aussie dollar, we've seen back at sub 72 cents this week. And part of that's a rising US dollar, because when there's risk aversion, often people will buy maybe the yen, Swiss franc, US dollars. So I've seen a bit of that. We've seen the Aussie dollar also coming off a little bit because of China concerns and iron ore, even though things like gas and coal are quite elevated at the moment. So we are getting some offset with, it's not all doom and gloom on commodities by any means. I think the RBA continue to be quite circumspect, and certainly compared to other central banks, they're still holding that they won't raise rates here to 2024. So that interest differential or projected interest differential is certainly more in favour of, say, New Zealand or the US than Australia. So that's also hurting the Aussie dollar. But I think on the flip side, by late this year, I suspect we will have better vaccination rates than most of our major trading partners. And if there is one thing that sort of our lockdowns are doing, and whilst it's incredibly painful at the moment, is I think they are pushing a lot of people that were sitting on the fence about vaccinations into getting vaccinations. And the latest projections are that Australia may get up to 90 or 92%, possibly, vaccination rates by late this year. Now, if we can do that and lockdowns and restrictions are eased, that should give the Aussie dollar some respite, and that may enable us to drift up towards that 74, 75 cents by year end. And I think it'll, continue to be very well supported around that 70 cent level. So, there's I think I saw a great chart the other night on the news. It was called the Wall of Worry, and it pretty well just had a whole raft of things that are concerning markets at the moment. And there are a lot of things coming together. But it may be, having said that, there are a lot of that's already factored in as well. And it may be that, I've sort of thought the Aussie dollar would bottom sometime in sort of around early late Q3, early Q4, because I do think by the end of the year, if we can get that vaccination rate up around 90%, we could start to look, and going into summer where people are outdoors and there may be less spread of COVID, we could go into the year end in quite a nice relative position.
And what should treasurers be keeping their eyes on, Michael, in your opinion?
Oh, pretty well everything we've sort of spoken about. I think as always, I like keeping a close eye on the longer dated bond yields. So I think, watch that 10-year bond yield. Some people are forecasting that could rise as much as, or as high as 2% by year end. So clearly, I'd be keeping a close eye on that. And related to that are credit spreads. So obviously, what spreads corporates or borrowers are paying over and above the government bond yield curve. I think that's certainly important to keep an eye on, and that's why anything's like if you get major defaults in China with property developers or whatever, anything that threatens credit spreads is something, particularly any companies with debt, should be keeping a close eye on. I think obviously what central banks continue to say. So there's no doubt that we continue to listen and watch for any change in language or rhetoric from central banks. I think they're most probably the main things. Obviously, continue to watch the major economic data, and I think unfortunately, COVID trends still are relevant, and continue, I think, to pay close attention, not just to what's happening here, but you know, if we do see further mutations or strains of COVID that make vaccines potentially less effective, that is a red flag, I think, and certainly that would give heightened risk aversion. So anything that can impact risk because of the way the Aussie dollar and our market trades is obviously also the other key thing.
Fantastic, Michael. Well, thank you once again for coming on. It's great to get your insights, and I look forward to chatting again soon.
Yeah, thanks, Simon.